Welcome to Module 5. We have covered market access and financial statement analysis. Now, let's shift to the strategy. Analysis tells you what to buy, but strategy tells you how much to buy, when to buy, and why you are buying it. This module focuses on making your portfolio resilient and aligned with your personal financial goals. All right, so in this module, we'll be looking at the differences between the value and growth investment investing philosophies. We also look at how to employ dividend investing strategies for consistent income, how to implement Naira cost averaging to minimize timing risks, how to apply the principles of asset allocation based on age and goals. Then we're going to look at how to structure truly diversified portfolio across local and foreign markets and learn effective tools for screening and building your stock watch list. So our goal is to solidify your personal investment philosophy. By the end of this module, you will have a clear documented strategy that removes emotion from your investing, which is the key to long-term success. All right, so in this video, I'm going to be talking about investing philosophy, the difference between the value investing and the growth investing, right? So under the value investing and the growth investing, we'll be looking at the goal, the characteristics, the risks, and their sectors. So for value investing, we said value investing, the goal of value investing is to buy high quality assets at a discount, while the goal of growth investing is to buy companies expected to outperform the market, right? Then for characteristics, we said in the value investing, we have low price to earning ratio, high dividend yield, and here investing is mostly in matured industries, right? Then for growth investing, we have high price to earning ratio, low or no dividend, and here we have high reinvestment. So the margin that they make from the business, they reinvest it into the business. Now for risks, here we have lower volatility but risks of staying cheap. Now when we talk about lower volatility, what we are trying to say is that the price of the stock does not increase or decrease in a sharp movement, right? It does not increase speedily. Why for growth investing there is higher volatility and risk of not meeting expectations. So there is more risk in the growth investing. Now, when I started investing in the stock market, there's this analysis I did about a biotech stock. And I think when I did the analysis, it was around 0.43 cents. Now, under 1 month, that stock grew to $32, right? So that's how the growth stock behave. So assuming you bought 100 of those stock, as at when the price was $32, you'll be making around roughly your capital should be around roughly $3,000, right? So you see that there is high volatility, and I've also bought a stock. I think I had 82 units of that stock. That stock went down to the extent that it dealt with my capital, right? So in for growth stocks, there's a high level of volatility, while in value investing stocks, there is a lower volatility, right? Then for sectors under value investing, we have banking sector, we have energy sector, we have the consumables, while for the growth investing, we have technology, biotech, and disruptive companies like AI. So I'd like you to know that your philosophy guides your decisions. Value investors are bargain hunters, right? They buy established companies trading below their intrinsic value, while growth investors are looking for the next big thing, accepting high prices today for explosive return tomorrow. So it's now left for you to choose the type of stock that suits or match your risk appetite and your time horizon, right? So it's now left for you to decide on which stock you deal with. And it's also advisable to diversify. You can have some value investing stocks, and you can have some growth investing stocks. I'll see you guys in my next video. Alright, so in this video, we're talking about generating income through dividend strategies. Now, you need to focus on companies with stable incomes, stable earnings that pay out a portion of profit as dividends, right? So now the key metrics you're going to look at here is dividend yield, that's annual dividend relative to the stock price, and the payout ratio, how they pay their dividend too. Then we're also going to talk about reinvestment, right? So reinvestment has to do with you putting back the money you earn as dividend into your shares. So you use your dividend to buy more shares, and as you are doing that, your capital is compounding. That's basically the secret of the stock market, the compounding interest theory, right? So as you reinvest your dividend back to your capital or to your stock, the the capital that you use to trade that company with that company is what is compounding and giving you more dividend. Now, we're also going to look at ways to mitigate risk, right? So examples of companies that pay dividends in Nigeria, we have most companies that pay dividends in Nigeria are the banking sectors and the industrial sectors. They are known for paying dividends, and also their dividend payout ratio is not that frequent, right? So most of the times they pay dividend after 6 months. Sometimes they pay every month, depending on the type of company you are dealing with. Now, dividend investing provides cash flow, right? This is crucial for retired investors, or it can serve as a source of capital for investment. So you can use your dividend as a source of capital to reinvest in that particular company. The magic here is the compounding effect, right? So reinvesting those dividends allows you to buy more shares, thereby making you to generate more dividend, and so on. You also need to always check out the payout ratio. When How frequent do they pay dividend? Like I know some foreign stocks that pay dividend on a weekly basis, right? If a company is paying out more than it is earning, that dividend is a red flag. So any company that pays dividend more than it earn, that's the price earning to dividend ratio, is a red flag, right? Just like just give them time, they'll float. So you should look out for companies that pay dividend more than they earn, and know that those companies are red flags. I'll see you in my next video. Alright, so in this video I'm going to talk about time horizon, the long term versus the short term, right? So when we talk about long term, you're looking at 5 years and above. Now this long term dey focus on fundamental analysis and intrinsic value. The goal for this long term is capital appreciation and compounding. So what you do here, you buy and hold, right? Fewer trades, low transaction cost, so you don't dash your broker too much money. Then for the short term, we have trades that are kept for weeks and months. So they focus basically on technical analysis, market sentiment, and news. The goal is capital gain from price volatility, that's for growth stocks. Then there is high risk and it requires dedication and superior timing. Now, when you do long term is actually where you extract all the juice in the investment, right? So most individuals that are interested in building wealth, they focus on long term. Why short term is kind of risky, because it has to do with speculating the move of the company that you're buying, and it's also emotional draining, right? So every now and then you'll be checking the price of your stock, whether it's going up, whether it's going down, and it's emotional draining. So the goal of every investor is that investor should have patience, that's number one, and should invest for long term. Now, you milk enough money from the market when you do long term investment compared to when you do short term investment. So the vast majority of wealth is built through long term investing. Short term trading is often confused with investing. It is highly risky and complex. So align your time horizon with your goal. Buying a house in 10 years requires a long-term strategy. Trying to double your money in a month requires speculation and it is emotionally draining. So that's the gist in terms of long-term and short-term. I'll see you guys in my next video. So in this video, we'll be looking at the naira cost averaging, or you can also call it the dollar cost averaging. Now, the principle behind this theory is investing a fixed amount of naira at a regular interval, regardless of the stock price. So you can decide to invest, let's say the first stock you bought, you invested, let's say 20,000 naira, and the price of the stock as at then was $7. The second time you invested the same 20,000 naira, the price of the stock was around, let's say, $6.12, right? You see that they are not in the same price, right? So the lower the price, the more unit of shares you buy, and the higher the price, the lesser unit of shares you buy. So when all your units are being summed together, the price of all your units is going to be calculated based on the average of the price you have spent in a whole, right? So it's better you buy regularly at intervals. It helps you to calculate the cost you spend in the stock market at an average. Now, the mechanism here is that you buy more shares when prices are low and fewer when prices are high. The benefit of this is that it reduces timing risks, removes the stress of trying to find the perfect bottom, right? And also, the second one is that it instills discipline because you're now converting investing into a saving habit, right? And it prevents emotional decision making. So this is ideal for consistent contribution to ETF. I told you guys that ETF is exchange traded funds, mutual fund, and quality blue chips. Now, dollar cost averaging or naira cost averaging in our context is the simplest and most effective strategies for beginners. It converts market volatility from a source of fear into a source of opportunity as you automatically buy more shares during downturns. The key behind all this is what is consistency. So when you are consistently buying stocks, depending on the price, whether high or low, but it's advisable to buy stock when the price is low, right? When all the units are being summed up, the price of that stock is going to be determined when the average of how much you have been spending every time you buy a stock is being calculated together, right? So that's why we call it naira cost averaging. So the cost of you buying the stock, the average the average stock price of all the money you have spent in buying the stock, that's what determines the value of one unit of stock you have regarding to the whole unit of stock you have. I believe you understand what I'm trying to say here. I'll see you guys in my next video. All right, so in this video, we're going to talk about diversification. That's the only free rush you have in the capital market, right? So now I've talked about diversifying. First set of diversification you need to do is local versus global. That's diversifying across the Nigeria stock market and the foreign markets, right? It is essential to hedge countries' risks and currency risks. So sometimes a country might be fighting or might be going through economical downtowns. If your investment is solely based in that country, that will also mean that your investment in that country will also what you also experience downturns, right? That's why we said you need to invest both in the local and in the global market. Then we also have sectoral diversification. Don't put all your capital into one sector. Example, you just carry all your capital and put into banking. What happened to AI? What happened to biotech? What happened to consumables? What happened to pharmaceutical sector? What happened to agricultural sector? What happened to the healthcare? Right? So that's why it is advisable to diversify. Then we also have the asset class diversification. So you can spread your investment across different classes. We have the equity, that's the stock when you buy shares from companies. Then we have the fixed income, talking about the bonds, right, and the treasury bills. And we also have the real assets. So let your assets or your capital be diversified into these three assets diversification. Make sure you have percentage of your assets or your capital in equity, that's the stock market. You have some of them which are the low risk investments assets, the bonds and the treasury bills. Then also put some of your capital in the real estate market or buy commodities like gold, silver and the rest of them. Diversification is often called the free lunch in investing because it lowers risks without necessarily sacrificing returns. If only one asset class or country is performing poorly, another might be doing well, right? Smoothing your overall returns. So the reason why we diversify is because in some seasons, some sectors might be doing well, others might not be doing well. Some country might be doing well, others might not be doing well. So if you have your capital shared among all these sectors, shared in the local market, shared in the global market, you see that you have nothing to lose. Even if this sector is not doing well or this country is not doing well, the return from other sectors and other countries will cover up and you still be after your break even, you still be in profit. So that's the only way you can make money in the stock market. I will see you in my next video. All right, so in this video, we'll be looking at asset allocation, how to balance risks and your age, right? So now in investing in the stock market, it is expected that the younger you are, the more aggressive you should go, and the older you are, the more defensive you should go. Now, this asset allocation is a strategic decision on how to divide your portfolio among asset classes. We talked about asset classes where we talked about stocks, bonds, real asset, and the rest of them, right? And we have a basic guideline on how to do this, on how to allocate our assets. We have what we call the 100 minus age rule. Now, this is where you subtract your age from 100 to determine the percentage of your portfolio that is going to the stock, right? So if you notice, you see that if you are, let's say, 20 years, if you minus 20 years from 100, you're going to have 80. So 80% of your portfolio is going to stocks. That means you're investing 80% of your capital to the stock market and is an aggressive type of what investment, right? So the more older you are or people that have reached retirement age, when they subtract their age from 100, you see that they are investing a little chunk or a little percentage in stocks and more percentage in bonds because bonds are lower risk what investment. So that is the rule that we're going to use to determine how we allocate assets in order to balance risks and also age. I'll see you guys in my next video. All right, so in this video, we'll be talking about how to build your watch list. Now, the purpose of building a watch list is for you to monitor potential companies, right? So you do analysis, you set those companies in a watch list, and you now wait for them to hit your price target before you execute the market. Now, these watch lists are built based on your fundamental analysis. You look at the return on equity, the low debt to equity ratio, and it helps you to track any reports, measure news release, and price movement. So, this your watch list define the price point at which you will take your action before you enter the trade. Now, a professional investor does not randomly scroll through the stock market. They have a watch list, companies they have already researched and vetted. This list allows you to act decisively when a compelling price point is reached, rather than scrambling to analyze a stock in a high pressure situation. So that's what your watch list. You have to do your fundamental analysis, pick a list of vetted stock and place them on a watch list, right? I'll see you guys in my next video. All right, so in this video, we'll be looking at stock screening, finding the gems in the market, right? So the function of this stock screening is that as an investor, you need to filter thousands of stocks based on specific criteria derived from fundamental analysis. So now we're going to look at the common filters that you need to do for you to screen a particular stock, right? So once the stock or the company you are screening meets up this criteria, that means you need to consider it. Now, for you to filter a company, you first of all look at the market cap, right? So example, the market cap should be greater than 10 billion naira. That's if it's a company in Nigeria. Then the price to earning ratio should should not be less than 15%, right? And the return on equity should be greater than 18%, and the dividend yield should be greater than 5%. So these are the metrics that you're going to use to filter this stock, right? And we have platforms. So for Nigerian, you can use the Nigerian Stock Exchange website. Then there's another website called investing.com. For that investing.com, you can use it for both Nigerian and foreign stocks, right? So these are the websites that you're going to use to check and to screen your stock. I'll see you guys in my next video. Oh, welcome guys to the summary of module 5, right? So we have looked at a lot of things in this module, the how to differentiate between value and growth stocks, diversification, asset allocation, setting your watch list, and screening stocks, right? So thank you so much for staying up to this moment. Now that you have a complete and a professional framework for managing your investments, that's a strategic blueprint. The final step is to put these plans into motion consistently. So don't just listen to this course or just watch this video. The knowledge that you have gotten from this video will not give you results if you don't put it to work, right? So in our next module, we'll be talking about market psychology and discipline. I will see you guys in module 6.